picture this. You are 55 years old. You have been working for 30 years. You have been contributing to your 401k, paying your mortgage, raising your kids, doing everything the way you were told to do it. And you have somewhere between $200,000 and $600,000 saved. You feel okay about it. Not great, but okay. Now here is the number that changes everything. The average American couple retiring at 65 will spend between $1.2 and $1.6 million in retirement. Not on luxury vacations, not on boats, on housing, food, healthcare, and basic living for approximately 20 to 25 years. If you have $400,000 saved and you are 55, you have 10 years to close a gap that could be as large as $1 million. And the way most people approach this, save a little more. Hope Social Security covers the rest. Cross their fingers is not math, it is a wish. This video is the math. Do you actually know the number, your specific number, that you need to retire? Not a range, not a rule of thumb, the real calculated figure based on your real expenses, your real Social Security benefit, and your real timeline. If someone asked you right now what your monthly expenses will be at 65, would you know the answer? If they asked what your guaranteed monthly income from Social Security will be, would you know that either? And here is the one that gets most people. Do you know what your portfolio needs to generate every month to cover the gap? That gap number is the only number that tells you whether you are on track. Most people at 55 cannot answer any of those three questions. Without those answers, there is no plan. There is only hope. By the end of this video, you will have the framework to answer all three. We are going through each one with actual numbers, actual formulas, and the exact calculations retirement planners use, the ones that typically cost $250 an hour to access. Let's start with the question almost everyone gets wrong first. The most common planning mistake at 55 is underestimating what retirement actually costs monthly. The default assumption most people carry that they will spend significantly less in retirement turns out to be wrong for the majority. In the first 5 to 8 years of retirement, most people spend roughly the same as they did while working or more. Travel that was deferred for decades suddenly happens. Home renovation projects that were put off finally get done. The grandchildren arrive, and you want to be present for everything. The spending drop, if it comes at all, tends to arrive in the mid-70s when health and mobility naturally constrain activity. So the first step in any honest retirement calculation is building a real monthly expense number, not the imaginary reduced version you tell yourself to feel better about your savings balance. Take your current monthly take-home pay and subtract three things. Your mortgage payment, if it will be paid off by retirement. Your retirement contributions, since you will no longer be making them. Any work-related expenses, commuting, professional clothing, work lunches. What remains is very close to your actual retirement spending in today's dollars. For most Americans in the 50 to 60 age range, this number lands between $4,000 and $7,000 per month. If you live in a high cost of living area, it is often higher. If your mortgage will still be running into retirement, add that back in. Now, here is a piece of the calculation that most people skip entirely. Health care. If you retire before 65, you do not yet have Medicare. Private insurance for a couple in their early 60s runs between $1,200 and $2,000 per month, and that is before out-of-pocket costs. Even after Medicare at 65, the average retired couple spends between $500 and $800 monthly on premiums and out-of-pocket costs. Fidelity estimates the lifetime health care cost for a couple retiring at 65 at approximately $315,000, and that figure does not include long-term care. So take your base monthly expense number, add health care. That is your real monthly retirement spending figure. Write it down, because every other calculation in this video depends on it. Here is the question that most people at this stage refuse to ask. Once you have that real monthly number, how much of it is actually covered by guaranteed income, and how much do you have to generate yourself? Retirement income comes from three possible sources: Social Security, any pension, and your personal portfolio. Understanding exactly what you will receive from the first two is the only way to know what the third one needs to deliver. Start with Social Security, because this is where the largest miscalculations tend to happen. Your Social Security benefit is calculated based on your highest 35 earning years. If you worked fewer than 35 years, the missing years count as zeros in the calculation and drag your average down. But the single biggest variable is when you claim. Claiming at 62 gives you approximately 70% of your full retirement age benefit. Claiming at 67, full retirement age for people born after 1960, gives you 100%. Waiting until 70 gives you approximately 124%. The difference between claiming at 62 versus waiting until 70 can be $500 to $800 per month for life. The Social Security Administration has a tool at SSA.gov called My Social Security. If you have not created your account and reviewed your estimated benefits, do it this week. Your personal projection is shown at 3 claiming ages. Those numbers are critical inputs to everything that follows. If you have a pension from an employer, get the exact monthly benefit amount and write it down. Now subtract your guaranteed monthly income from your real monthly expense number. What remains is the income gap. This is the amount your portfolio must generate every single month for the rest of your life. This is the number that determines whether you have enough saved. Once you have that income gap figure, the question becomes, how large does your portfolio need to be to produce it reliably without running out of money before you die? The answer to that is not what most people expect. This is the chapter where the actual math lives. The standard formula used by retirement planners is called the 4% rule. It comes from research conducted by William Bengen in 1994 and has been tested extensively since. The principle is straightforward. A diversified portfolio can sustain annual withdrawals of 4% of its initial value, adjusted each year for inflation for at least 30 years. Across virtually all historical market conditions, including the Great Depression, the 1970s stagflation period, and the dot-com crash. The math works as follows. Take your monthly income gap and multiply by 12 to get your annual income gap. Then divide that number by 4%, or equivalently, multiply it by 25. The result is your portfolio target. Here is a concrete example. Suppose your real monthly retirement expenses are $6,000. Your Social Security benefit at age 67 will be $2,400 per month. Your income gap is $3,600 per month, or $43,200 per year. Multiply $43,200 by 25. Your portfolio target is $1,080,000. That is the amount your retirement portfolio needs to be on the day you stop working to sustainably support your income gap for 30 years. Now do that calculation with your own numbers. Take your real monthly expense figure from Chapter 1. Subtract your guaranteed monthly income from Chapter 2. Multiply the annual gap by 25. That number is your personal retirement target. Not some national average, not a television talking heads ballpark figure. Your number, based on your real inputs. Most people at 55 who run this calculation for the first time find themselves looking at a gap between what they have saved and what they need. That gap is not a crisis. It is information. And there is a specific 10-year window ahead of you in which the decisions you make matter more than any other decade in your financial life. What most people do not realize is that the arithmetic of the final decade is fundamentally different from the accumulation years, and understanding that difference changes the entire approach. The last 10 years before retirement have a disproportionate impact on your final portfolio balance, far greater than any 10-year period before them. This is because of compound growth working on a much larger base. Consider someone who has $400,000 at 55. If that portfolio grows at 7% annually without any additional contributions, it becomes approximately $787,000 by 65. But if they contribute an additional $2,000 per month for those 10 years, the portfolio reaches approximately $1,100,000. The same 7% growth rate, but the contributions add roughly $300,000 in additional ending balance. The math gets even more powerful when you account for the IRS catch-up contribution rules, which exist specifically because Congress recognized that people who arrive at their mid-50s with savings gaps have limited time, and need higher contribution limits. After age 50, you can contribute $30,500 annually to a 401k, $23,000 standard plus $7,500 in catch-up. For IRAs, the limit is $8,000 per year, including the catch-up. For self-employed individuals using a SEP IRA or solo 401k, the limits go considerably higher. If you are 55 and earning a household income of $120,000 or more, maximizing both a 401k and a Roth IRA represents approximately $385,000 in contributions over 10 years. At 7% average annual returns, the compounded value of that contribution stream over 10 years is approximately $530,000. There is one additional dimension to the final decade calculation that determines not just how much you will have, but how much of it you actually keep, because the tax structure of your savings matters as much as the amount. By 55, the single most important savings decision that most people are not thinking about carefully enough is not how much to save. It is which account type to save it in. A traditional 401k or traditional IRA reduces your taxable income today, but those accounts are not tax-free. They are tax-deferred. Every dollar in a traditional account will be taxed as ordinary income when you withdraw it in retirement. A Roth account works the opposite way. You contribute after-tax dollars today, no deduction, but every dollar of growth and every dollar you withdraw in retirement is completely tax-free. No tax on the gains, no tax on the withdrawals, and critically, no required minimum distributions at 73, which means you control when and whether you access the money. At 55, if your income is still at or near its peak, you are probably in the 22, 24, or 32% federal bracket. The standard advice: always maximize traditional contributions because the deduction is worth more at higher income, has a hidden problem. It assumes your tax rate will be lower in retirement. For many people who successfully save into seven figures, it will not be. Required minimum distributions from large traditional accounts can push retirees back into higher brackets. They can trigger the Social Security tax torpedo, which taxes up to 85% of your benefits, and increase Medicare premiums through IRMAA surcharges. The more effective approach for most people at 55 is a deliberate split. Continue contributing to a traditional 401k to capture the employer match and reduce current taxable income, but also open or maximize a Roth IRA. And in years where you have flexibility, consider Roth conversions, a sabbatical, a lower income year, a year between jobs. These are moments to move pre-tax money into tax-free accounts at lower cost. The goal by 65 is to have flexibility, some money in traditional accounts, some in Roth, and some in taxable brokerage. That mix gives you the ability to manage your taxable income in retirement, minimize bracket creep, reduce Social Security taxation, and stay below the IRMAA thresholds. That flexibility can be worth $30,000 to $50,000 per year in after-tax retirement income on a 7-figure portfolio, and it is entirely determined by decisions you make in the decade before you stop working. If you ran the calculation in Chapter 3 and found that your portfolio target is larger than your current savings balance, you have company. A significant share of Americans in their mid-50s are in the same position. The question is what to do about it practically with the time and income you actually have. The most important step is replacing vague intention with a concrete annual contribution target. Take your portfolio gap and divide it by the number of years remaining. That gives you a rough annual savings requirement. It will not be perfectly precise because it ignores investment growth on existing savings, but it gives you an order of magnitude check on whether your current contribution rate is meaningfully connected to your target. If the gap requires more than your income can support through contributions alone, the conversation shifts to 3 other variables working 2 to 3 years longer than planned, reducing your target monthly spending in retirement, or accepting a more modest portfolio target by using Social Security optimization to maximize guaranteed income. Delaying Social Security from 62 to 67 increases your lifetime benefit substantially. And for every year you delay beyond 67 to a maximum of 70, your benefit grows by 8% per year. A guaranteed inflation-adjusted, lifelong return that no investment account can replicate. The final thing to understand about the gap is that closing it is not only about saving more. It is about protecting what you have already built from the sequence of returns risk that becomes most dangerous in the 5 years immediately before and after retirement. A portfolio that drops 30% at age 63 creates a different and more damaging outcome than the same drop at 43 because you have less time to recover and because withdrawals taken from a depleted base accelerate the depletion further. A 2 to 3 year cash reserve entering retirement held in high-yield savings or short-term treasuries allows you to weather an early market downturn without selling equities at the worst possible moment. So let's bring this back to where we started. You are 55. You have 10 years. The math is not complicated, but you have to actually run it. With your numbers, your expenses, your Social Security projection, your income gap, and your specific portfolio target. That calculation, done once and reviewed annually, tells you more about whether you are on track than any account balance update, any market forecast, or any television segment on retirement. The people who arrive at 65 financially secure are not, in most cases, the highest earners. They are the ones who did the calculation, understood the gap, made targeted decisions, and stayed consistent for the decade when it mattered most. The math was always available to them. They just chose to use it. Run the numbers. Write down your monthly retirement expenses. Pull your Social Security projection from ssa.gov. Calculate your income gap. Multiply by 25 to find your portfolio target. Compare that to where you are today. The number you see, whatever it is is information, and information is what makes a plan possible.